This is your Wall Street wake-up call. China's economy growing at 6.7% in the third quarter, according to new data. And here with analysis is Jasper Lawler, a market strategist with CMC Markets in London. So Jasper, this number met economists' expectations and was sort of the same growth rate we've been seeing all year in 2016, but the stabilization was largely driven by government stimulus, right? And that's not exactly what economists want to see. Of course, we saw 6.9% growth throughout 2015.
Good morning, Scott. Yes, I think this is a largely another breather sigh of relief quarter for the Chinese economy. If you just look at the Chinese yuan, its currency, it's trading at the lowest levels it has all year. So the last thing that we need is a repeat of the way we started 2016 was fears over the Chinese economy and another bout of currency devaluation. That doesn't look like it's on the cards. As you said, it's just flatlined at 6.7% year-over-year growth. The concern, of course, as you've raised, is that a lot of that growth comes from the areas of construction, largely related to what is becoming another slightly blown up housing bubble. So at some point in the future, the government's going to have to address that to make sure that financial stability is maintained. And that might mean it has to accept lower growth rates. At the moment, the government looks pretty. That 6.7% fits right in between its 6.5 to 7% annual growth target. Next year, to address these possible problems with the housing market overheating, they may have to lower down that target, and so that will bring some growth concerns back to the fore again.
But do those growth concerns sort of start those stock market volatility, that volatility we saw earlier this year, or is that kind of market reaction kind of over here, that investors are a little bit more used to some headwinds out of China?
Well, I think it's largely been the government stimulus that's propped up the growth, which has alleviated those concerns. So once the government takes a policy U-turn of no longer supporting the economy in the way it has done this year, then I think that's when you start facing the growth fears, and that's when the market starts to react again. And I think it's almost poised to react with the currency at the levels that it is. Obviously, we've got a lot of US dollar strength to consider alongside that because of the prospects of the Federal Reserve raising rates, so there's that relative difference. But still, I think that the currency could certainly suddenly start to devalue again if there's signs that the economy is slowing and that money starts flowing out of the economy again. So it's still very much a risk factor looking into 2017, but just not as much as it could have been had these figures look weaker.
All right, and just quickly, there are questions in terms of how long the government can actually stay in the picture with China debt at 250% of GDP. Is that obviously a concern that you're hearing?
Yes, it's a credit-fueled growth at the moment, and the government has to make the decision, does it want to continue this transition towards a more consumption-based economy, which it is actually achieving. The consumption met over 70% of the GDP in this last figure. So consumption, the Chinese consumer is taking over the role that manufacturing and exports used to do. But is it going to sacrifice that in order to maintain these high growth targets? Or is it actually going to accept that the growth probably needs to be slower to continue that transition?
All right, Jasper Lawler from CMC Markets in London. Jasper, thanks for joining us as always.
Thank you, Scott.
I'm Scott Gamm, and you're watching The Street.